Car insurance costs are crushing American drivers. Millions of safe drivers across America are paying 40% more for auto insurance this year, despite never filing a claim or getting a ticket. What's happening isn't just unfair. It's a systematic exploitation of drivers based on factors that have absolutely nothing to do with how safely they drive. From June 2022 to June 2024, the average annual cost of auto insurance in the United States rose by more than 40% according to the National Association of Insurance Commissioners. That's an additional $700 coming out of your pocket every year. But here's the part that should make your blood boil. This massive increase has nothing to do with your driving record and everything to do with a rigged system that's designed to extract maximum profit from the people who can least afford it. Let me tell you about Sarah, a factory worker from Seattle with a spotless driving record. She's never had an accident, never gotten a speeding ticket, and has been driving for 15 years without incident. Yet GEICO charges her 45% more than her neighbor down the street, who happens to be a plant superintendent with a bachelor's degree. Same neighborhood, same driving conditions, same risk level. But because Sarah didn't go to college and works in manufacturing, she pays nearly half again as much for the exact same coverage. This isn't an isolated case. It's happening everywhere, and it's getting worse by the day. The insurance industry has spent decades perfecting a system that punishes people for being poor, for living in certain zip codes, for having the wrong job, or for not having a college degree. State Farm, GEICO, Progressive Corporation, and Allstate have created a complex web of non-driving factors that allow them to charge different prices to different people for identical coverage, all while hiding behind the claim that they're simply assessing risk. But here's what they don't want you to know. Their own data proves that safe drivers are being systematically overcharged, while dangerous drivers with higher incomes get discounts. The Consumer Federation of America conducted a comprehensive study that revealed something shocking. In over half of their tests, a moderate-income driver with a perfect driving record was charged more for basic insurance than a high-income driver who had caused an accident and been convicted of speeding within the past year. Think about that for a moment. You can have a flawless driving record spanning decades, and according to National Highway Traffic Safety Administration data showing that experienced drivers have 60% fewer accidents than new drivers, you'll still pay more than someone who literally crashed their car last month, as long as they make more money than you do. This backward system becomes even more infuriating when you look at specific companies. Progressive Corporation charges moderate-income perfect drivers more than higher-income dangerous drivers 86% of the time. GEICO does it 70% of the time. State Farm, despite being America's largest auto insurer with over 10% market share, follows similar discriminatory pricing patterns. These aren't accidents or glitches in their pricing algorithms. This is deliberate policy designed to extract maximum profit from working-class Americans. The weapon of choice in this systematic exploitation is your credit score. As many as 95% of auto insurers use credit information to price policies in states where it's legally permitted under the Fair Credit Reporting Act. They claim your credit score predicts how likely you are to file a claim. But what it really predicts is how much money you have and how much they can get away with charging you. If you have poor credit, you'll pay 105% more than someone with excellent credit for the exact same coverage. That's not a typo. You'll literally pay more than double. The average driver with poor credit pays $2,729 per year, while someone with exceptional credit pays just $1,308. That's a penalty of $1,421 per year, or $204 extra every single month for having the audacity to be financially struggling. But credit scores are just the beginning. Insurance companies have created an entire menu of socioeconomic factors they use to jack up your rates. They look at your level of education, your occupation, whether you own or rent your home, and even whether you've had continuous insurance coverage. None of these factors have anything to do with how safely you drive, but they have everything to do with how much money you have. The zip code discrimination is particularly insidious. According to Consumer Federation of America research, a good driver living in Buffalo's lower income, predominantly African American 14215 zip code, gets quoted premiums that are 34% higher than an identical driver living next door in the wealthier, majority white 14226 zip code. In some cases, drivers can be charged 62% more than someone living literally across the street simply because of which side of the zip code boundary their house falls on. J. Robert Hunter, the Consumer Federation of America's Director of Insurance and former Texas Insurance Commissioner, puts it perfectly. It is profoundly unfair that a driver with a moderate income and a perfect driving record is often charged more for auto insurance than higher-income drivers with DUIs, accidents, and speeding tickets. The industry's response to this criticism is predictably tone-deaf. They claim they're not discriminating based on race or income, they're just using actuarially sound factors to predict risk. But as Carmen Balber, Executive Director of Consumer Watchdog, puts it, it really is a proxy for race and income. Douglas Heller, an insurance expert for the Consumer Federation of America, is even more direct. Insurance companies once drew red lines around communities they didn't want to serve. Now they overprice them. While you've been getting squeezed for every dollar, the insurance industry has been laughing all the way to the bank. According to fresh data from the National Association of Insurance Commissioners, property and casualty insurers made $166.8 billion in profit in 2024. These record-high profits were up 91% from 2023 and 330% from 2022. Let me repeat that. While they were raising your rates by 40%, their profits increased by 330%. The industry collected more than $1 trillion in premiums for the first time in history, while simultaneously claiming they needed to raise rates because of increased costs. It's the oldest trick in the corporate playbook: cry poverty while posting record profits. But the systematic exploitation doesn't stop there. The insurance industry has now partnered with automakers to spy on your driving habits without your knowledge or meaningful consent. On March 11, 2024, the New York Times broke the shocking story that car companies had been secretly collecting detailed driving data from internet-connected vehicles and selling it directly to insurance companies. General Motors, through their OnStar program, was collecting information on every trip you took. Start and end times, duration, distance, speed, and acceleration patterns. This data was then sold to companies like LexisNexis and Verisk Analytics, who packaged it up and sold it to insurance companies. Vehicle owners who saw their premiums skyrocket had no history of accidents or dangerous driving. But their insurance companies now had detailed profiles of their every movement. The deception was breathtaking. Automakers used what are called dark patterns, deliberately confusing interface designs, to trick customers into enrolling in these data collection programs. Many drivers thought they were simply signing up for roadside assistance or vehicle diagnostics, not realizing they were giving permission for their insurance companies to track their every move through telematics systems. The backlash was swift and fierce. After the New York Times expose, General Motors was forced to end their OnStar Smart Driver program in April 2024. But the damage was already done. Millions of drivers had already seen their rates increase based on this secretly collected data. Texas Attorney General Ken Paxton filed lawsuits against both GM and later against Allstate and their telematics partner Arity, alleging conspiracy to collect and sell data from over 45 million Americans without proper consent. As of November 2024, 32 separate lawsuits have been filed against automakers and data brokers over this practice. Senator Edward Markey summed up the outrage perfectly, stating that automakers used deceptive design tactics known as dark patterns to manipulate consumers into signing up for programs in which driver data was shared with data brokers for subsequent resale to insurance companies. The insurance companies try to justify this surveillance by claiming it leads to more accurate pricing, but the reality is far different. While companies like Root Insurance price primarily on driving behaviors, traditional insurers like State Farm and GEICO use telematics to extract additional data points for pricing discrimination. A 2024 study from Consumer Reports found that the median savings for drivers enrolled in telematics programs was just $120 per year, a pittance compared to the privacy invasion and potential for abuse. Meanwhile, only 41% of drivers are even aware that their credit rating affects their car insurance premiums, and an even smaller percentage know about the dozens of other non-driving factors being used to set their rates. The industry has deliberately kept consumers in the dark about how their pricing actually works, making it nearly impossible for people to understand why their rates keep going up despite their safe driving. The good news is that the tide is starting to turn. 4 states, California, Hawaii, Massachusetts, and Michigan, have completely banned insurance companies from using credit scores to price policies. 3 more states have restricted their use, and lawmakers in Maryland, Missouri, New York, North Carolina, and Tennessee have introduced new legislation to put restrictions on data collection and use. California's Proposition 103, passed by voters in 1988 and overseen by Insurance Commissioner Ricardo Lara, remains the gold standard for insurance regulation. It requires that rates be based primarily on driving record, miles driven, and years of experience, factors that actually relate to driving safety. The result? California drivers pay some of the lowest rates in the country relative to their risk levels, saving an estimated $154 billion since implementation. But for the majority of Americans living in unregulated states, the exploitation continues. The industry's own projections show rates continuing to climb in 2025, with a projected 7% increase nationwide, and with potential tariffs on imported car parts, which make up 60% of replacement parts, rates could go even higher in 2026. The systematic overcharging of safe drivers has created a crisis of affordability that threatens the entire auto insurance system. The Insurance Research Council found that 1 in 7 drivers, 14% of all motorists, are now driving without liability insurance because they simply can't afford coverage. In some areas, like Washington, D.C. and New Mexico, nearly a quarter of drivers are uninsured, according to NHTSA data. This creates a vicious cycle where the remaining insured drivers have to pay higher premiums to cover the costs of accidents involving uninsured motorists, which pushes even more people out of the market. The industry's greed is literally destroying the system they claim to be protecting. The solution isn't complicated, it just requires political will. States need to follow California's lead and ban the use of non-driving factors in insurance pricing. Credit scores, zip codes, education levels, and occupations have no place in determining how much you pay for car insurance. Your rates should be based on how you drive, how much you drive, and how long you've been driving, period. Until that happens, millions of safe drivers will continue to subsidize discounts for dangerous drivers who happen to have more money. The industry will continue to post record profits while working families struggle to afford basic coverage. And the fundamental promise of insurance, that good drivers pay less than bad drivers, will remain a cruel joke. The next time your insurance bill arrives and you see another massive increase despite your spotless driving record, remember this. You're not paying more because you're a riskier driver. You're paying more because a rigged system has decided you don't have enough money to deserve fair treatment. And until we demand change from our elected officials, that system will keep extracting every dollar it can from the people who can least afford to pay.